How is everyone doing? Welcome to the Strategy Room. You are here with your host, Dr. Joe Berquist, on this lovely Saturday night, June 27th, 2026. I thank you so much for joining me here this evening. I've got a jam-packed show for everyone tonight, as we normally do. We got a whole bunch we're going to talk private credit. We got a little bit of some Fed news that we got to talk about, bank stress tests. We got to talk about inflation numbers. I've got all kinds of things with prediction markets, poly markets. We got AI stuff to talk about. We're gonna look at OpenAI, Anthropic, maybe not doing those IPOs, maybe some reasons why, maybe not. We'll take a look at all that as we get into a bunch of different things. But first, I wanted to give a shout out. My baby girl is competing in nationals for gymnastics right now. She is down in Greensboro, North Carolina. So I just want to give a little shout out to my baby girl down there who's doing well, I know she's going to do a fantastic job down there competing in nationals. So just saying hi and with a little shout out to her as we kick off the evening here. But with that being said, let's get into all of our normal stuff here, shall we? So, as we always do when we start off every evening, we're going to take a look at the national debt clock. So, we're still coming in at $39.3 trillion on U.S. national deficit. Now, that equates to debt per citizen of 114,000 and a debt per taxpayer of $356,000. U.S. federal budget spending is at $7.2 trillion, with the U.S. federal budget deficit at $1.655 trillion. So the debt to GDP, now that is federal debt to GDP, is at 121.97%. That, as I always say, is a very bad number. We want to get that number way, way, way lower. And then just a couple of other things to point out here. The interest on the national debt is still over $1 trillion, a huge number. Defense spending remains up at $941 billion. And then credit card debt still hovering, actually inching closer to that 1.4 trillion mark. With it, that equates to a debt per cardholder of $8,414 on average. So again, just a lot of these numbers that I'd like to show everybody as we start the discussion through the evening, because it kind of helps to guide us a little bit as we get through and we talk about some of these different things. Now let's take a look at what were markets doing this week. Now, the Dow, S&P 500, it was a little choppy up and down this week. It kind of bounced around a little bit, but I mean, not a horrific week. Nothing really going on there. But let's take a look with bonds. So we saw interest rates just ease off a little bit, not a ton, but just a little bit. So the 30-year bond again was creeping up at that 5%, a little over 5%. That has now dropped down to 4.866%, which is good. Our 10-year treasury note is down to 4.371%. That is good. As I've always said, that is the rate that drives everything in our lives. So if you're a consumer out there, if you're looking at residential mortgages, auto loans, student loans, credit card loans, the 10-year treasury is where it's at. That is the one key interest rate that drives all of the consumer interest rates. So that's why that is such a key number to, or key interest rate to always keep an eye on. So, but again, that had gotten up to almost as high as 4.5%. It is now eased back to 4.371. Hopefully that will continue to ease back further, because really where we want the real sweet spot for that is we'd really like that to be at 4% or a little below 4%. So hopefully we begin to trend back down. The 2-year treasury note is hovering just a little bit above 4% at 4.098. Now, looking at the short term T-bills, right? We got the 1-year T-bill 3.922, the 6-month at 3.921, the 3-month bill at 3.754, and the 1-month bill at 3.665. Now, what is interesting, the one phenomenon I had been pointing out to everyone over the last few weeks was how tightly the short-term T-bills were trading with each other. I mean, it was almost no spread. It was basically about 3.7% for each one of these bills, which was really interesting because that's not normal activity for how they operate. We've seen though the 6-month and the 1-year basically at no difference. At no difference right now. Through both trading at 3.92%. which again is an interesting thing. We'll have to keep an eye on that. The question is, so the Fed in recent months has been stepping back in. They've been buying more T-bills. They've been buying more bonds, especially on the short end of the curve, on the short-term notes and everything. So the question is, why is that not having more of an effect? That I think that's a big question there. We don't really know. We don't really have a great answer for that right this minute, but it will become clear as it always does in not too distant future. So, all right, let's take currencies. All right, now I really wanted to look at commodities for a minute here because as we could see here with crude oil futures and Brent crude futures, they have really come down, dramatically come down. They are now, crude oil futures is now down to $70.24. Brent crude futures are down to $73.60. That is absolutely fantastic. When we go back to where we were just 5 days ago on crude oil futures, we were hovering around $80. And if we go back over the last 3 months, we had gotten as high as $112 back on right around, April 5th or so. So to have come down in basically less than 2 months' time, for us to have gone from $112 all the way down to $70.24, that's really good. That is really good. We're definitely heading in the right direction. Now, just a couple other things to point out here. Gold has dropped back down to $4,103, which again, it's come way back. Gold had hit as high as 5,000, a little over 5,000. So for that to have backed all the way off, all the way back down to 4103, that's again always interesting to watch that. Silver futures, same thing. Silver futures, you can see in the chart here, had spiked up, whereas as high as recently as May 11th. Silver futures were up as high as $90, and now we're back to $59.16. So again, just good to keep that. Natural gas futures continue to stay in a certain range here, about 323. So again, they're kind of holding kind of in a pattern, if you will. So again, but just wanted to point that out, how much the crude oil futures have dropped and dropped, dramatically. Now, obviously things in the Middle East are not fantastic. We still got, a kind of a flare up today with more bombing. So, we'll see what that, transpires, but hopefully, I'm still hoping for the best here. I'm still hoping for the best here, but we'll see. We'll see what happens. We'll keep an eye on it. Now, where were mortgage rates at? So let's take a look at mortgage rates for a second here. So mortgage and refinance interest rates as of today, Saturday, June 27th. So lowest 30-year rate since April. So that's good news. So according to average rates from the Zillow Lender Marketplace, the current 30-year fixed rate fell by 13 basis points to 6.17. The 15-year fixed rate fell by 5 basis points to 5.75, and the 5/1 ARM fell by 22 basis points to 6.09%. This is the lowest 30-year rate we've seen since the end of April. So again, good news. So like I said, that 10-year treasury was backed off a little bit. So that therefore 30-year interest rates coming back down about 13 basis points. So again, this is good. We're heading back in the right direction again. So just to recap here real quick. So mortgage rates, 30-year fixed, 6.17%. 15-year fixed at 5.75%, still a great rate. 5/1 ARM at 6.09, and the 30-year VA sitting at 5.69%. So again, not terrible. Not like I said, despite everything that's happened the last 3 or 4 months, these rates have remained in a very reasonable area. Again, the sweet spot, we would certainly like rates to be back down below 6%. That would be the ideal place that we're looking for. But having it at 6.17%, not terrible, not the worst, definitely not the worst thing in the world. With that, like I said, with everything that's going on in the world, these rates could definitely been a lot higher right now. We could have been looking at rates back up toward closer to 7%. So like I said, not too shabby. Now on the refinance end, just real quick on the refinance end, 30-year fixed at 6.26%, a little bit higher. 15-year fixed at 5.73%, the 5-1 ARM at 6.18%, and the 30-year VA at 5.61%. And that's just for refinancing rates for residential mortgages. So again, residential mortgage rates, but overall, not looking too shabby. Things hanging in there. Rates have come down a little bit, and as they said, these are some of the lowest rates that we have seen since the end of April. So that's a good sign there. Very good sign. Now, um, before we get into all of our news here for a second, I just wanted to show this to everyone. So couple of things that the federal regulators have done. So there's been a lot of talk about reporting thresholds in the banking world, and this is really big. This is really important. Now, and it's interesting because I'd been waiting for a while to hear if this was like official, and it is official. But I was also waiting for and hoping that there would be some articles about, so I'm like, hey, someone's going to cover this, right? Bloomberg, the Wall Street Journal, Financial Times. Nobody's really covered this. It's just kind of like the regulators put it out there, and there it was. So I basically did just a simple Google search here, basically just saying, okay, did the regulators pass these new threshold changes? And then the answer here is yes. Federal regulators have actively approved and proposed several major adjustments to bank asset and regulatory thresholds to reduce compliance burdens and account for inflation. So the first one here, the FDIC audit and reporting thresholds. So the FDIC approved final rules effective January 1st, and that was January 1st of this year, updating 12 CFR Part 367. This includes raising the internal control assessment, also known as the ICFR, audit threshold from 1 billion to 5 billion, and annual reporting thresholds from 500 million to 1 billion. It also implemented ongoing automatic indexing for inflation. So that is enormous. The other thing here is the deposit insurance assessment changes. So the FDIC board approved a proposal to raise the asset threshold for defining a small versus a large institution for deposit insurance assessments from 10 billion to 30 billion, with periodic adjustments for inflation. It also proposed lowering initial base assessment rates across the board. So what does this mean? Like, why is this significantly? It is significantly important. It's a major deal because as banks approach so there were a couple big, let me start with this. There are a couple big thresholds in banking. There's the 1 billion mark. There is the 10 billion mark. There's 50 billion, and then there's 250. Well, I mean, 100 billion could be in there too a little bit, but then you've got the ultimate mark is kind of like when you go over 250 billion. But when you hit these thresholds, you have to grow very quickly because basically every time you hit one of these thresholds, the bank is going to get hit with a new amount of regulation that's going to add a ton of cost on top of the bank, tons of brand new costs, brand new regulation. And the bank has to be able to absorb that. So, for example, if you were around $1 billion and you were going to cross that $1 billion threshold, your bank was probably going to have to absorb around somewhere in the neighborhood of $250,000 in new regulatory costs. Now, the one way to think about that is if you hired, say you're paying 5 employees on average with benefits and everything around 50,000 a year. That would be the equivalent of hiring 5 employees that never show up for work and never do anything for you. So when you get to that $1 billion threshold, it's not enough to just, oh, hey, we made it to $1 billion and we crossed it by a couple $1,000s or whatever. Like, no. You have to very quickly get the bank up to 1.3, 1.4, 1.5 billion in assets in order to be able to absorb those new regulatory costs that you are going to incur by crossing that threshold. Now, what does that cause? That has led to a lot of the mergers and acquisition activity that we have seen over the last, 15 years or so in the banking business, because a lot of banks basically look at it and they go, man, we're getting pretty close to $1 billion. We're getting pretty close to 10 billion. We've got, we have a whole heap of costs on us. Do we want to do this, or does it just make more sense to sell the bank to another player? And depending on a number of factors, most likely the age of your CEO, the age of your board members, they're going to make that determination. They're going to look at their strategy, they're going to look at their resources, and they're going to basically say, okay, look at their market and say, all right, can we grow this thing fast enough to make this thing work, or are we going to run into problems? And would it be a smarter play to sell the bank as opposed to that? So this has been something that I believe has been very real, has contributed in a very big way to a lot of banks selling themselves in some respects, perhaps needlessly, just because this was just a regulatory cost burden. That's all these thresholds are. So again, I think pushing these thresholds back, especially here going from 1 billion to 5 billion, this is a monumental change, because now there are so many banks out there that will be able to they'll be able to grow organically, cross that $1 billion threshold, and they will not have to worry about incurring any more additional costs. So it's not going to be this big panic as you get up to that $1 billion threshold and begin to try to grow over that. And again, going from 1 billion to 5 billion, that's a lot of elbow room. That is a lot of elbow room. So that is a very, very good thing. And again, and also changing from the 500 million to 1 billion range as well. So again, I think this is really going to help. And again, this is not going to stop like M&A activity altogether or dramatically slow it down or anything like that, but I think it will take some of those potential M&A transactions off the board, because again, banks will be able to just naturally grow in just a regular organic way without having some kind of massive panic attack as they come up on these thresholds. So again, just very, very critical, but just wanted to point out these are some really big and I think really good changes for the banking industry. But anyway, all right, let's jump into a lot. We got so much to get to here tonight. So first thing up, Alan Greenspan, former chairman of the Fed, dies at age 100. Now, I'm not going to talk about, I actually did a whole special episode on this for Wednesday. I had some other things that I was going to roll out or we were going to get into, but with this kind of threw me a curveball. So unfortunately, with Alan Greenspan passing away, this is a really, really big deal, and I felt like I needed to shift things up a little bit. So I ended up doing a special episode on Wednesday covering the passing of Alan Greenspan, former Federal Reserve chairman at age 100. But let's look at this for a second here. So Alan Greenspan presided over the Federal Reserve for 19 years under 4 different presidents, from Presidents Reagan to George W. Bush. His comment in 1996 about investors' irrational exuberance initially shocked the markets, but the bubble didn't burst until 2001. With a couple of choice words, he can momentarily send the stock market to heaven or hell, a Washington Post column said in 1997. Now, Alan Greenspan, for anybody who doesn't know, he was a giant of a man in the banking world, the Federal Reserve world, the finance, the world of finance, the world of economics. Alan Greenspan was just a giant in this world, and he perhaps wielded more power. He certainly wielded more power than any Federal Reserve chairman in my lifetime. Like he had it, man. And he was the real deal. Alan Greenspan was the real deal. He was a brilliant guy. He was a brilliant economist. He really understood economics and finance. Really had it down there. I have had I've had a lot of critique of a lot of the more recent Federal Reserve chairmen. And Alan was interesting because it wasn't like he had this over the top flamboyant personality. It really wasn't like that. He was actually kind of a very low key, soft spoken type of guy, but he could be he could be charming. He could be funny in his own way. He could be very endearing. He almost kind of came off in a certain respect like your grandpa up there, like when he'd go up to Capitol Hill to kind of talk to Congress. So he just had a way about him, and he did. I would say through the first, probably 12, 13 years that he was head of the Federal Reserve, he pushed all the right buttons. He knew how to do. I mean, everybody fell down, especially as we got toward the second half of the 90s, from like 1995 through 2000. Alan Greenspan could just do no wrong. I mean, he was at the top of the world, and everybody just, I mean, everybody fawned over him. And what's interesting is there's a couple of key things you have to understand is that Alan Greenspan, he changed the way that the Federal Reserve interacted with us. He changed like the way that the Fed chairman conducts interviews, conducts speeches and everything. He changed a lot of that. He started doing it in a very different way than it had ever really been done before, even going back to Burns and Paul Volcker. So he kind of ushered in that change. And with that change, we also got the advent, cable television toward the end of the 80s really took off. And then obviously in the early 90s, we got the creation of CNBC, the first major, business news network that was just, just covered the business world all day long. And of course, CNBC, they love them some Alan Greenspan. It even got to the point at the end of the 90s where they even had what was called Green Speak. For anybody that remembers that, they had Green Speak, where they would literally, he put out his policy statement, go, give a brief interview or press conference, and they'd spend the next 10 days deciphering every word in that thing, man. Like, all right, well, it's Green Speak. Alan said this, but he really means that, and you have to decode it. And we're, it really got kind of wild at a certain point. Um, but but I would say there is a giant but, unfortunately, with Allen. There's a giant but, because Allen, I think, looking back on it now, I think it is fair to say that Allen overstayed his welcome. I think Allen stayed for probably about 6, maybe 7 years longer than he should have. I think again, you can kind of understand why. I think Allen fell prey to, when you start, like, in other words, when you start believing your own press, that's maybe when it's time to go. And I think that really happened to Allen. I think a lot of stuff, probably, I think just the coverage, the constant fawning over, the kissing of his butt 24/7, 365, this kind of thought that he was this totally perfect economist and Fed chair and could do no wrong. And that was true until it wasn't true. And unfortunately for Allen, his legacy is being the one who brought us into the bubble economy. We get the dot-com bubble, and then, he let asset prices, run wild throughout the 90s, leading to the dot-com bubble. He talked about, irrational exuberance, but it was, it was Allen that played a big part in creating that irrational exuberance. We can't forget that. And then after 9/11, he brings interest rates down, leaves them down too low. The real estate market begins to form, and then just balloons, mushrooms in size. And then, of course, Allen steps down in 2006, and about, a year later, we have, boom, the giant market meltdown and everything else that happened thereafter. And again, you can't blame what happened on Ben Bernanke, because it all built and grew and metastasized under Allen's. That was all done and happened under Allen's watch. And I think that Allen was smart enough to recognize that this thing is probably going to blow up, and I need to get out of Dodge. I already had the dot-com bubble burst. They already put that on me. I don't want a real estate bubble bursting here on me too. But unfortunately, even so, it came back on him. And now I will say this, to Allen's credit, he did own a lot of this stuff. And, over the last 10 years, he did own a lot of this stuff, and he came out and said, you know what, I did make a lot of mistakes, and there are some things I wish I could go back and do a little bit differently. So I gave him I give him a lot of credit for, at least being able to own up to some of this stuff and saying, you know what, I did make some big mistakes here. I wish I could go back and change some of that stuff. So Alan Greenspan, at the end of the day, leaves a little bit of a mixed legacy in his passing. But what you can say here is that, he was a brilliant guy. He was, for the most part, a very good Federal Reserve chairman. He did a great job, and like I said, you can't. Nothing could change that. There was a moment in time that he was a giant of a man in the business world, in the finance community, and so again, he really was a fascinating guy and did a lot of very interesting things in his time there. I said, he was at the head of the Federal Reserve for literally almost 20 years, and I think he was just short of, I forget the chairman. There was the one chairman who was there from in the 50s and 60s. I think he served 20 years, and Alan Greenspan was literally just a little short of that at the end of the day. But like I said, unfortunately though for Alan, he does leave a little bit of a mixed legacy at the end, with bringing us into the age of bubbles, or the bubble economy, if you will. But like I said, just wanted to spend a few minutes here to acknowledge the passing of a man who was larger than life, Alan Greenspan. God rest his soul. Lived to live to be 100 years old. Amazing. So again, we honor Alan here a little bit tonight. So, all right, let's move into other things. So I've got some other Fed news here. So Kevin Warsh, keep it busy here in his first couple weeks here at the Fed. So Warsh taps two veteran Fed economists as advisors. So Daniel Kovitz and Eric Engstrom, longtime Fed staffers, will assist the new chairman on policy and analysis. So Federal Reserve Chairman Kevin Warsh has tapped two veteran central bank economists to serve as advisors, according to people familiar with the matter. Daniel Kovitz, who is one of three deputy directors in the Fed's Division of Research and Statistics, and Eric Eggstrom, a senior associate director in the Division of Monetary Affairs, will advise Warsh. Both are longtime staffers steeped in the workings of an institution Warsh has pledged to retool. The additions are among the first moves Warsh has made since taking over last month. Warsh's recent predecessors also tapped one or two senior advisors from the existing staff shortly after taking office. So now we also know, as I had reported on last week, that the Federal Reserve has, at least Kevin Warsh, I should say, at the Federal Reserve, he has created 5 committees. And those 5 committees are going to look at a number of different items. They're going to look at what type of inflation or what type of data are we really using to assess inflation and some other items around the economy. It's going to look at, he's going to have one on employment. He's going to have one on inflation. And one, I think, is going to look at the Fed's balance sheet. And then the other one is just, I think he's really keen in on, he would like to really get away from this notion of forward guidance. He really liked the Fed Reserve governors to stop putting out what's called the dot plot, to basically stop, basically telegraphing to the markets constantly what they're going to be doing, or what they expect to have happen. Kevin Warsh would really like to get away from that. And I think that's a good thing. I think the Fed should be doing that. So anyway, so he's got these 5 committees. He just tapped these 2 veteran economists there at the Fed to basically help him do some of this stuff. So we'll continue to go on with that. Now, another thing here, Atlanta Fed search for new leader stalls. The process of selecting a new bank president stalled and has been restarted. White House advisors have taken an interest in a process that they have no formal role in. So the search for a new leader at the Federal Reserve Bank of Atlanta has stalled after an initial slate of finalists didn't yield a choice, forcing the bank to reboot a process now entering its 7th month, according to people familiar with the research. Now, they didn't interview me yet. No, I'm just joking. I'm just joking. Like, no, they. But seriously though, I'm open. I'm available. I'm available. I would be a slam dunk, right? Come on. Somebody's got to give me. Come on. Let me get some comments in here. Come on, you guys can roast me a little bit here. I don't mind. So anyway, the episode is on its surface a procedural complication, but it is unfolding at a time when the Fed's independence for political control has come under strain. The Reserve Bank presidents are central to that independence. They help set interest rates, and their appointments are deliberately shielded from the political process that governs the rest of Washington. The selection of a regional Fed president is a two-step process. Each of the 12 reserve banks is overseen by a board of 9 directors, 6 of whom choose the bank's next president. Their choice must then be approved by the Fed's Washington-based Board of Governors. The two bodies traditionally collaborate so that the district advances a candidate Washington will accept. The process, however, can be unwieldy. The local directors, though accomplished business and civic leaders, have seldom run a search for a policymaker who will help steer the economy for years to come. The Atlanta Fed interviewed a slate of finalists in April with an eye toward announcing the selection by May, according to people familiar with the matter. So, again, this is one of those things we'll have to keep an eye on to see what happens there. Now, my interview is coming up next week, so they'll probably make a decision. No, I'm kidding. I added that last bit. I added in there. I don't have an interview with the Atlanta Fed. Even though that'd be pretty good. It'd be a good gig, right? Becoming a president of a Federal Reserve Bank. I think that's a good gig, right? That's good. It's a good spot. All right. So the search continues here for the next Atlanta Fed president. So we'll see. I'll keep an eye on that and report back to see what happens there. Now, the Fed's Neil Kashkari doing exactly what the new Fed chairman, Kevin Warsh, does not want them to do. But so the Fed's Kashkari says the Fed may have to raise rates this year. Neil Kashkari says inflation risks have led him to pencil in one rate hike by the end of the year. Now, this is exactly the type of telegraphing that the Federal Reserve, the new Federal Reserve Chair, Kevin Warsh, wants them to stop doing. He wants them to stop going out and giving these press conferences or speeches where they're basically, again, giving forward guidance and telegraphing to the market, oh, okay, this is what we're going to do. Because again, I think what is interesting here is that, there's a lot of pressure for them to raise inflation, and we're gonna take a look at some inflation numbers here in just a few minutes. But the problem here, if you will, is that it's what's called a supply side shock. In other words, we had the oil shock due to the war, skirmish, whatever, with Iran. And that's what really drove the inflation numbers up. So historically speaking, raising interest rates does not help when the reason for the inflation was a supply side shock, like an oil shock. Okay, that is what we know from the history. That's what the history of economics has taught us. So and again, I'm not saying that it may not become at some point a necessity to increase interest rates, but I would just pump the brakes on that right now. I think what they do right now is they should just hold tight. Just hold tight. Give it, maybe give it to the end of the year. Just wait to see what happens. There's no rush. You don't need to do anything. Just sit tight at the moment and see what happens. Like I showed you here, again, these Brent crude oil futures, they've again coming way down. Brent crude oil futures at $70.24. So again, we've seen these numbers coming way down. So let's and it's not going to dramatically change the inflation numbers like in a month or 2 months. We're going to have to give this thing 3 or 4 months to see what happens here. But like I said, we'll see what happens there. But again, just wanted to note this because Kashkari, he's out there doing what, again, Kevin Warsh would really like them to stop doing, and that is telegraphing what the Fed is going to be doing going forward with interest rates. So, all right. Now, we had the annual Federal Reserve stress test over the last couple of weeks, and the big banks ace what is being called an easier stress test. So JP Morgan, Bank of America passed tests with flying colors after the Fed last year began releasing details in advance. So JP Morgan Chase, Bank of America, and a collection of their peers all passed the Federal Reserve's annual stress test, a widely expected outcome after regulators last year began disclosing the exam's scenarios and models in advance. The Fed on Wednesday said that big banks were equipped to weather severe economic headwinds after putting banks through a hypothetical situation where a severe global recession leads to significant declines in commercial real estate and house prices and rising unemployment. Bank capital fell only slightly, staying well above the minimum level at which the Fed considers banks to be safe. Big banks responded with buybacks and dividend hikes, with JP Morgan saying it would repurchase 50 million in shares, and Morgan Stanley saying it planned to repurchase 20 billion worth. Wells Fargo and Goldman Sachs announced the dividend increases, but no immediate buybacks. As a group, the banks would have faced 708 billion in total loan losses under the stress tests. Still, capital declined in aggregate only 1.6%, the smallest reduction of any test in the last 7 years, thanks to projected interest rate income. The results won't come as a surprise. Acting under legal pressure, the Fed in late 2024 said it would begin releasing the scenarios and the models they use to calculate how well banks fare in any given hypothetical. Critics of the move have accused the Fed of giving away the answers to its own test before it happens. The scenario this year was also similar to last year's, and the Fed announced in advance that it wouldn't affect banks' capital buffers, giving ongoing plans to change the exam. Normally, individual results from the test are used to determine how much more capital a bank must hold, known as the stress capital buffer. To defend against economic downturns, banks are required to hold a certain amount of capital in reserve instead of lending it out to generate profits. The annual stress test looks at what would happen to banks under adverse conditions. This year, 32 banks were put to the test, including a number of large regional banks that aren't subject to the test every year. So again, I think good news for the most part. Like I said, a little bit of question there because it seems like the Fed did give them the answers to the test, if you will. So, but overall, I think that a lot of things in the banking business are pretty solid right now. Earnings are pretty solid, margins are pretty solid. Net interest margin is good. Delinquency still remains very low, even though we have some issues, particularly private credit, which we'll get into a little bit later tonight. So even though there are, and obviously office buildings were been a big problem for the last couple of years. We've got the idea of the maturity wall in commercial real estate. So again, there are some issues or some things on the horizon there, but for the most part, things have been pretty good in the banking business the last couple of years, and I think that is reflected in the stress tests. And so, banks did pretty good. Looks like if we did face a severe downturn, the effects on a lot of at least the biggest banks in the country wouldn't be that dramatically horrible. And we'll see what happens there. So again, just wanted to report on that. So now, JP Morgan had a little bit of excitement this week, a little bit of as the world turns, if you will. So JP Morgan names Doug Petno and Troy Rohrbaugh as co-presidents as longtime exec Marianne Lake exits. So a little bit of drama, a little bit of management shakeup here at JP Morgan. Now, why does this matter? Now, Marianne Lake had been there for a very long time. She was, I believe, the CEO of their consumer business at JP Morgan. Now, Marianne Lake was widely expected to be one of the top few contenders to take over for Jamie Dimon whenever he chose to step down. Now, he had been saying in the last year or so that basically he was only planning on being there for a couple more years, maybe 2, maybe 3. He said that his timeline had definitely dropped below 5 years, and that kind of signaled to a lot of people that okay, maybe it's 2 years, maybe it's 3 years. We'll have to see what the deal is there. But again, Marianne, she was one of the front runners, and so now with obviously they told her she wasn't going to get the job, so she rolled out. She is retiring, and now we've got Doug and Troy are there fighting it out like the apprentice of old. Going out of here. So JP Morgan Chase has promoted 2 of its top executives, Doug and Troy, into newly created co-president roles. Marianne Lake, one of CEO Jamie Dimon's most prominent potential successors, is leaving the company. The move reshapes the leadership team beneath Jamie Dimon, who is 70 years old, who has repeatedly said the bank's board has multiple executives capable of eventually becoming the CEO. Dimon currently expects to remain CEO for roughly 3 more years, though that timeline could change, according to people familiar with knowledge of his thinking. So again, little bit of a, like I said, a little bit of some soap opera there at JP Morgan this week. So we'll keep an eye on this, and we'll be keeping an eye on Doug and Troy, and we'll see how they do here over the next year or two, and see if one of these gentlemen is able to get the leg up on the other, and maybe rises to replace Jamie there one of these days. So we'll see. It's hard. It's hard. I've said this many times. Love him or hate him, Jamie Dimon, he has etched his name in the banking history books. When 50, 70, 100 years from now, when people are writing about this period from like 2000 to 2026, 2030, whatever, Jamie Dimon, he will be the guy. He will be just like just like the name, just like JP Morgan back in the early 19th century, when he or 20th century, I should say, when he stepped in 19 to help squash the Panic of 1907. So just as JP Morgan was a giant of a man back in those days, and he really a lot of the books and focus there in the early 20th century, so is Jamie Dimon at the focus of everything that has happened here in the first 25, 26 years of this century. So he's already etched his name in the history books, and whether you like it or not, Jamie's going to be a tough act to follow, because he has done an amazing job there at the head of JP Morgan. He has turned them into the biggest, baddest bank in the world, and you got to give him some kudos for that. So, and I don't know that I necessarily would want to follow Jamie. I don't, because that's a tough one to live up to. So, all right, now some big shakeups on Capitol Hill this week. So the senators had basically the House and the Senate, they had passed this new housing bill, which had a lot of bank regulation tied into it. Now, Trump basically canceled the signing of this bill ahead of basically a very tense meeting with GOP senators. And I wanted to report on it because this bill did have a lot of banking regulation that was tied into it, and a lot of good things, a lot of things that the banking lobby and a lot of bankers that really wanted a lot of, some different things, different types of regulatory relief and things like that were going to be in there, that was really going to help. So hopefully, I just wanted to point it out, and hopefully this can get, resolved here in a not too distant future, and hopefully this doesn't sit out there. But this housing bill aims to increase supply and make homes more affordable, and was heralded as a major win by both political parties. Trump said he would not sign the bill until Congress passed a controversial voter ID bill, only controversial to people who don't want it, known as the Save America Act, which has stalled in the Senate. After canceling the bill signing, Trump attended a scheduled meeting on the Hill with Senate Republicans that attendees said turned contentious at times. Yes, I think that is a nice way of saying it. I think it got pretty heated. So, but anyway, but we'll keep an eye on that one, and we'll come back now. Some of the big news of the week here: core inflation rate hits 3.4% in May, the highest since October of 2023. Now, this was the Fed's preferred gauge, which is also known as the PCE index here. So the core personal consumption expenditures price index showed a 3.4% annual rate after rising 0.3% for the month. The core annual reading was the highest since October of 2023. The Fed's primary inflation gauge also showed an annual rate of 4.1%, the highest since April of 2023. Even with the elevated inflation levels, consumer spending for the month came in stronger than expected. Personal consumption expenditures rose 0.7% for the month. Also, gross domestic product, the broadest measure of growth, rose at a seasonally adjusted annual pace of 2.1% in the first quarter, up 0.5 percentage points from the prior reading. So yes, gross domestic product, GDP, it was revised upward for the first quarter. So that was some very good news that came in there. Personal consumption expenditures were, rose, like I said, about 0.7% for the month. So we're not seeing a massive slowdown in consumer spending. Now, I will say this. Um, This is the reading for May, and the core inflation here, the PCE inflation index, it was anticipated. This was not unanticipated. It was anticipated that it was basically going to hit its highest peak here in May, and then it was going to come down thereafter. And I think this is why markets did not freak out over this news, so to speak, because basically the premise here was that okay, it did go higher, but this was expected. We were expecting the number to kind of peak out here in May and then come back down over the next few months. So again, I think things were in a certain respect playing out as predicted, or as the market, as Wall Street thought that this was good, this was going to go. But so anyway, so I wanted to point out that now here's one of the interesting things about this. Let's look at a couple other articles here for a second. So, what is now kind of contributing to this rise in inflation? And part of it is the whole AI data center boom is definitely adding to inflation. So I had these two articles here. So number one was a rise in memory chip costs push pressure on retailers of laptops and smartphones. So AI demand is contributing to a memory chip shortage. As a result, the prices of some consumer electronics are beginning to rise. Apple announced it's raising its prices on MacBooks and iPads, passing along the rising costs of memory to consumers, with the potential for more price hikes down the road. So far, Best Buy said customers are still spending, but the electronics retailer expects its computer division to be the most affected. So, yes, so very, very interesting there. And then we go to this Wall Street Journal article, which is the data center boom is sparking a third wave of inflation. Demand for memory chips is pushing prices higher. Will AI's promise of increased productivity come in time to temper that inflation? So we can see here change in consumer prices for computer software and accessories from a year earlier. So we can see here they have spiked up over 15% just in the last year. So that is a pretty dramatic increase. So President Trump's trade wars have waned. The price of gas is finally falling, but inflation has a new catalyst. America's massive artificial intelligence build out is beginning to push up prices on everything from smartphones to electricity. The question now is how widely that build out might ripple through the economy and how long it could keep inflation elevated. The answers will have big consequences for the economy. The money pouring into the AI arms race is unprecedented. Analysts peg capital spending at five of the so called hyperscalers, which are Alphabet, Google, Amazon, Meta Platforms, Microsoft, and Oracle, at $741 billion this year, according to FactSet, up nearly 75% from last year. And so we can see this chart here. Again, the five big hyperscalers, and you can see how much, and I've talked about this over the last 2 3 months. You could see here how much the capital expenditures are going to be 26, 27, 28, 29. You're talking about they're going to get into the trillions of dollars, which is just, just crazy. And you kind of sit there and you go, how are they going to spend this money? Like how are they going to spend this insane amount of money? It's going to be a fascinating thing to watch, because how are they going to fund it all? It's like just they're just pumping out bonds, I guess, right? Pumping out corporate bonds. Where is all that money going? While much of the conversation is focused on what AI can do, the build out itself is strikingly physical, said Columbia University economist Stinge van Nieuwerburg. The data centers used for AI require sophisticated computing equipment, cooling systems to keep that equipment from overheating, electric and fiber optic cables, and backup generators to prevent power disruptions. Based on announced and planned developments, Van Nieuwenberg estimates that spending on the AI build out through 2032 could come to about $8 trillion, nearly 5 times the market value of the entire New York City property market. With so much demand, prices are rising for many of the things that go into the AI build out. And because of those things are used for more than just AI, those price increases are spilling over into the broader economy. Primarily memory and storage chips are in there. So again, we'll keep an eye on this, and we will see if again this whole data center AI build out if this continues to be something that continues to stoke inflation. So we will keep an eye on that. All right, now getting back to Kevin Warsh for just a second here. So we see this big inflation number, and now the question becomes, okay, Trump had been beating up Jerome Powell, for the last, almost year and a half, basically saying, I want you to lower rates, lower rates, lower rates. So now we get this. Trump eases pressure on Fed Chairman Kevin Warsh as inflation tops 4%. So some economic advisors to President Donald Trump are signaling more patience for the new Federal Reserve Chairman Kevin Warsh's decision last week to hold interest rates steady as the president continues to call for rate cuts. Those advisors and the president aren't reading the data differently, a White House official said. What has changed is simply a new face at the Fed. Warsh is getting an extended policy grace period as he navigates challenging inflation data after inflation rose 4.1% in May. So, Kevin Warsh here, basically, I guess you could call this the honeymoon period. He's going through the honeymoon period, and we'll have to see, what ultimately comes about with that as we get in there. Now, Scott Bessent basically says that GDP growth can return to 3% before the end of the year. So Treasury Secretary Scott Bessent expressed confidence Wednesday that the U.S. economy can get back on the path to 3% growth as the Iran war nears a conclusion. Growth, however, has been slow over the past 2 quarters as the domestic economy has battled a number of factors. So, yes, so we shall see what ultimately happens with this. I do wonder a little bit. Can this really go? Because again, a lot of this is based on the AI trade. A lot of this has been based on the White House has put a lot of their eggs into the AI trade, and is the AI trade, the data center boom, is this going to really drive and propel the economy forward? And I really think that remains to be seen. And why I say that is really based on some of the conversation we're going to get into in the second half of the show tonight, when we really start getting into a lot of the AI and the data center conversation. So kind of put a pin in this for the moment, and we'll be back to it. Now, this was something that was very interesting. It was very unexpected this week. Factory job cuts in June neared financial crisis and COVID levels, according to S&P Global. So job cuts at U.S. factories ran near their highest levels since the end of the global financial crisis in 2009 and the COVID-19 pandemic, as worries grew over global demand and rising costs, according to S&P Global. Broadly, the S&P manufacturing flash reading for its Purchase Managers Index came in at 55.7, up narrowly from May, and better than the Dow Jones consensus estimate for 54.8. So, again, it's kind of interesting that the flash reading, basically came in at 55.7, up from what was expected of the 54.8. But yet we had these big job cuts in U.S. Factories. So again, we'll have to keep an eye on this and see what happens. But again, this was unexpected. This was definitely unexpected here. So all right, let's keep going. Now, this is something that I think should send chills up people's spines. This was highly troubling here. Let me blow this up a little bit here so everybody can see this. So, digital euro plans clear major hurdle in EU Parliament. So, and this headline did not do this justice here. So, the Economic Committee gave the green light to the European Central Bank's proposal for a Eurozone-wide digital currency, for basically a central bank digital currency. They gave the go-ahead for this. This is highly troubling. So the European Parliament gave its backing on June 23rd for the European Central Bank to launch a central bank digital currency version of the euro. The draft regulation approved by the European Parliament's Economic Committee states that the introduction of the digital euro would reduce over reliance on non European providers by becoming a pan European means of payment and would bring the single currency into the digital era by giving union citizens the freedom to opt to pay with central bank money in their daily transactions. The proposed digital currency will essentially function as an electric wallet guaranteed by the ECB but markets by banks or fintech companies and will be usable by all Eurozone residents to make payments online and in person. That wallet will be subject to an as yet undecided holding limit. The member of the European Parliament appointed to head the legislative process for the legislation, Fernando Navarro Rojas, a Spanish economist, said that with the single currency package, we are protecting citizens' freedom to choose how they pay until we decide to lock them down. Sorry, I added that last part there. We are strengthening access. Oh, this is interesting. We are strengthening access to and acceptance of cash while making central bank money available in the digital form. So, how exactly are you strengthening access and acceptance of cash? That is a curious comment. Um, this is I have said this before. I've been on this bandwagon for a long time. We do not want a central bank digital currency. Period. End of story. Do not want it. I think people, people talk about books like 1984 by Brave New World, all these kind of things. Again, I look at a central bank digital currency and I see something that could be massively abused. Massive. I mean, abused on a level that you could not believe. And I have, and again, I say this all the time. Like what? Well, why would you think that it would be abused? Whatever. Like, just look at what we have seen. Look at what happened during COVID. Look at how badly look at the lockdowns and everything, and just the ridiculousness of everything that happened there. The governments around the world have shown that they can and will abuse our rights to no ends. And again, and what bothers me about this is you look at some of the other things going on in Europe, and you look at, oh, we're gonna block, we're gonna block teenagers who are under the age of 16 from being on social media. But that's not really what they want. That's the cover. What they really want is that you're going to have to get a digital ID. If you're a parent and you want to get your kids back on social media, you as the parent have to fill out and accept a digital ID. And then that's when they got you. So they're going to force everybody in Europe to get this digital ID, and then therefore then because that's the only way they'll allow your kids to basically be online, so the kids will be pressuring the parents. It's very, I give them credit. It's a little ingenious for how they did this, because what they're using is they're going to use the teenagers as their foot soldiers to force the parents to basically get the digital ID so that the kid can get online. Because if you're 13, 14, 15 years old, there's no way that you're going to, you're going to lose your mind if you can't be on social media with all your friends. And they know this. They know this. This is not this is not anything crazy. They know this. So again, you see the digital ID going in, and now it's like, oh, okay, now we're going to roll out the digital currency. And what troubles me about this is that, again, this is all the stuff that Davos has been saying for the last 10 years, that they were going to roll all this stuff out. This is going to be the digital currency, and we're going to roll out the central bank digital currency and the digital IDs, and we are going to control and monitor every little stake in aspect of your life. And if you do anything that we don't like, we're going to lock you down, lock you out, basically prevent you from doing anything. Now, why does this matter to us here in the US? Some of you might be watching this right now and going, wait a minute, why do I care? Right? Why, okay, Europe's doing this, central bank. Why do I care? Well, part of the third piece of crypto legislation, you had the Genius Act, you had the Clarity Act, but then you also had the anti CBDC Act, the Anti-Central Bank Digital Currency Act that was passed by the House. And that, for all intents and purposes, has now effectively died in the Senate. It is ridiculous that the Senate did that. I think that I called it the three-legged stool of crypto regulation, and I felt that you needed to have all three pieces of the puzzle in place. Now, if the Senate fails to push through this House bill, if they fail to pass the anti-CBDC Act, which I think is ludicrous if they don't, what will happen is that you will have China with their own central bank digital currency, which they already have. You will have the euro with its own central bank digital currency. And then what happens? Oh, voila. You will then hear the Fed say, hey, guys, in order for us to be competitive in the world, you know what we're going to need to have? Oh, that's right. We're really going to have to roll out this central bank digital currency. And I know that some of you out there don't like it, but we're just going to have to do this because it's for your good, and we need to do it to stay competitive with other economies around the world, because we just won't be able to compete if we don't have this central bank digital currency. And that's where ultimately this is all going to lead. So again, I say it right now, this should send a shiver up your spine, because once they have this, this is going to be crazy. This is going to become a nightmare for Europe, man. This is just mark my words right now. Mark my words. And it's very unnerving. It is unnerving that the central bank digital, the whole consideration, the central bank digital currency. And I will tell you, this is a banking podcast. But I am also a man of very deep faith and very deep belief and convictions. I'm Catholic, and I have read my Bible, man. I have read my Bible, and I would tell you something. If you've never read Revelation, you should go back and read Revelation, because there's this little thing in there called the Mark of the Beast, and it sounds an awful lot like what could eventually unfold with a central bank digital currency. And I'm not being a preacher. I'm not preaching. I'm just telling you that it's there. And if you haven't read it, you might want to go pick up a Bible and go read Revelation. You might find some very interesting parallels between things that are happening in our world today and things that have already been written about 2,000 years ago. So again, just pointing that out. All right, but let's keep moving on here. So now has Wendy's become the new meme stock? That's a good question here. So GameStop had been the meme stock soup du jour, if you will, for quite a long time now. And now all of a sudden, everybody's jumping on Wendy's. So new meme stock Wendy's soars more than 25%, with trading halted at one point. Now, this was on Wednesday. And Wendy's shares rallied amid a surge of retail investor enthusiasm. Trading was briefly halted by the New York Stock Exchange for volatility shortly after the open. Now, that happened on Wednesday. And then on Thursday, we got this. Wendy's turns lower as meme rally fails to extend for a second day. So, again, we'll see what happens there with that. Has Wendy's become this new meme stock? I think it's a very interesting thing to ask, and we will keep an eye on that and see what happens with that. Another interesting thing that happened this week: Alphabet got added to the Dow Jones Industrial Average, replacing Verizon. So now Dow Jones Industrial Average is made up of 30 stocks. Usually these are what are considered blue chip stocks in the Dow, and they do get replaced from time to time as companies grow larger, and as some of the companies on the scale, maybe as they shrink or become a little bit more stale, or they see some underperformance, they do occasionally get replaced. So Alphabet again gets added in here to the Dow Jones Industrial Average, and they end up replacing Verizon. So Alphabet will replace Verizon in the Dow Jones Industrial Average. The California-based company will join mega cap tech peers NVIDIA, Apple, Amazon, and Microsoft in the blue chip index. Honeywell would remain in the Dow following the completion of its spinoff of Honeywell Aerospace. So yes, so just an interesting thing to note in the change in the Dow Jones. So, all right, now Let me see here. I got SBA. Okay. I'm going to come back to the CEO thing, but let's just talk about SBA for a second, and then I'm going to shift gears because I want to get into what I like to get into as far as like economic indicators for the week coming up. I want to give you guys some bank news and some other stuff. So, but here SBA. Let's blow this up a little bit here, shall we? SBA beefs up loan limits to historic levels. Here's what's changing. So the Small Business Administration raised combined 7A and 504 loan limits to $10 million. The SBA announced a $50 million grant program for small manufacturers training and consulting. The agency expanded the International Trade Loan Program to include manufacturers and food-related businesses. So this is all really good news. So the Small Business Administration is beefing up its guaranteed loan limits to 10 million, the highest in agency history. That's through a new rule the SBA announced on May 18th that allows small businesses to combine their 7A and 504 loans for up to 10 million in SBA financing. That includes small manufacturers who could currently secure an unlimited number of 504 loans as long as each loan is tied to a separate project, and will now also be able to apply for 5 million through the 7A loan program. So the new rule is effective July 4th. The previous loan limit for combined SBA backed programs was 5 million. By doubling the combined loan limits of SBA 7A and 504 loans, this administration is empowering job creators, particularly manufacturers, to invest in American workers, rebuild our industrial strength, and grow the small business economy, said SBA Administrator Kelly Loeffler. The new rule comes amid a flurry of activity for the agency, much of which has been targeted to manufacturers. On May 1st, the SBA opened the doors to manufacturers and related industries being eligible for its International Trade Loan Program. Loans through that program come with a 90% guarantee, which is great, compared to a 75% guarantee for loans made through the SBA's primary 7A lending program. That followed a March announcement that allowed food related businesses into the ITL program for the same enhanced government federal guarantees. That expansion applies to small businesses engaged in select farming sectors, as well as ranching and meat production, alongside packaging and machinery manufacturers. The SBA last year also rolled out the 7A manufacturers access to revolving credit, also known as MARC loan program, to offer working capital to small businesses engaged in manufacturing that the agency said would provide maximum flexibility and minimal red tape. Now, the MARC loan limit is 5 million, with the SBA guaranteeing 85% of loans up to 150,000 and 75% for loans above that up to the maximum. Another new SBA initiative heading into 2026 was the waiving of most loan fees for small manufacturers. That means for 7A loans up to 950,000, the upfront fee is now zero. For all 504 manufacturing loans, the upfront fee and annual service fee is zero. These new reduced fees went into effect on October 1st, 2025, and run through September 30th, 2026. So, and then other new SBA programs, the Patriot Pitch Competition is part of the federal government's 250th anniversary celebrating the founding of America. According to the SBA, the program aims to reward small businesses that represent the promise of American innovation and opportunity, and that have used qualified SBA products. So again, we'll keep an eye on that. And then some of the other ones were Manufacturing in America, E2G Grant Initiative, and the Empower to Grow E2G program. So again, lot of good stuff I think happening with the SBA. Again, if you especially if you're in that manufacturing world or want to be in that manufacturing world, if you want to manufacture something, like these are some really good incentives and really good programs here at the SBA for people to get into. So, all right, now, like I said, let's shift gears here. This is the time in the program where I want to give everybody the economic indicators that are going to be coming up this week. I want to give everybody some banking news, and I also want to share with everybody the episodes that I put out this week for the podcast. So just a second. Just needed a little bit of water there. All right, so economic indicators coming up this week. So nothing on Monday. And then on Tuesday, June 30th, we get the Chicago PMI, the CB consumer confidence. We get the JOLTS job openings for May, the API weekly crude oil stock, On Wednesday, July 1st, we get the ADP non-farm employment change for June, manufacturing PMI for June, construction spending for May, ISM manufacturing PMI for June, the Atlanta Fed GDP now for second quarter. Then on Thursday, July 2nd, we get the average hourly earnings for June, initial jobless claims, continuing jobless claims, non-farm payrolls for June, participation rate for June, unemployment rate for June, factory orders for May, and the U.S. Baker Hughes total rig count at 1 p.m. On Friday, there is no data coming out, obviously in observance of the July 4th holiday, which is on Saturday. But a lot of places are celebrating because it's on a Saturday. A lot of places celebrating it on Friday this year. So, but again, a lot of big economic information coming out this week. A lot of jobs data, and information coming out. So we will keep an eye on all of this stuff. So now, tell you what, let me get into. All right, went through the economic. I'll tell you what, let me do my bank news and then we'll run through our episodes of the week, shall we? Let's do that. So, okay. Durable goods orders decreased in May. Personal income and spending, they also rose in May. The first quarter GDP was revised up to 2.1%, as I had mentioned earlier tonight. FHFA, the Federal Housing Finance Agency, for the first quarter, enterprise mortgage foreclosures actually dropped. So the Federal Housing Finance Agency reported that the 60-day delinquency rate for Fannie Mae and Freddie Mac decreased to 0.81% in the first quarter, while the serious delinquency rate rose to 0.59%. Foreclosure starts declined 2.8% during the quarter, while third-party and foreclosure sales increased to 6.6%. Mortgage applications increased for the week. New home sales drop in May. Fed, large banks pass the annual stress test. Yes, we talked about that a little bit earlier as well. The FFIEC publishes data on mortgage lending. So Trump issues orders on quantum resilience. So President Donald Trump issued executive orders on protecting against cryptographic attacks and enabling quantum innovation. State Farm Bill draft text released. So Senate Agricultural Committee Chairman John Boozman released draft text of proposed Farm Bill language, a section-by-section summary, and a title-by-title summary. So we will keep an eye on how that Farm Bill gets drafted there. ICBA objects to Cantera Labs Trust Bank charter application. Just as they have objected to a lot of the other bank charters that a lot of other fintech players have gotten. The ICBA urges review of Kraken's access to Fed payment services. So ICBA said it has significant concerns around Kraken Financial's limited purpose Federal Reserve payments account, given recent reports concerning Kraken's business relationship with cryptocurrency kiosk operators allegedly involved in scams. So yeah, we will keep an eye on that one. OCC proposes supervision framework for stablecoins as far as anti-money laundering and CFT programs. So the OCC issued a proposed rule to implement Bank Secrecy Act and sanctions compliance standards applicable to permitted payment stablecoin issuers as required by the Genius Act. So, and then agencies propose requiring stablecoin issuers to maintain effective customer ID programs. So federal banking regulators issued a proposed rule to implement the Genius Act's directives to treat permitted payment stablecoin issuers as financial institutions under the Bank Secrecy Act and to require issuers to maintain an effective customer identification program, also known as CIP, KYC, Know Your Customer. So again, very interesting. We'll have to keep an eye on that one to see how some of that unfolds as per what has been put out there through the Genius Act so far. OCC releases lending handbook. Trump requests economic assistance for farmers. Yes, so we'll see what goes on with that. FDIC proposes ICBA advocated flexibility for banks to share CSI. So the FDIC Board of Directors advanced a proposed rule to allow banks more flexibility to share confidential supervisory information for appropriate business purposes, as advocated by ICBA. Fed proposes reducing the DIF assessments for community banks. Now, that is the Depository Insurance Fund, is also known as the DIF. The FDIC proposed reducing deposit insurance assessments by 2 basis points for banks subject to the small bank scorecard, again, as advocated by the ICBA. So we'll keep an eye on that. FDIC board to discuss deposit insurance assessment adjustments as of today, which was yesterday, I think. The FDIC announced that its board of directors will meet today to discuss a proposed rule on deposit insurance assessment thresholds, rate schedules, and adjustments. So it'll be interesting to see what they ultimately come out with that. ICBA citizenship executive order shouldn't burden community banks. So ICBA told the administration President Donald Trump's executive order on financial services should ensure policies related to immigration impose no additional regulatory burdens on community banks. Now, I just have to say, I kind of laugh over this one because if the government wants banks to check on a customer's immigration status, it's not that hard, and it's really not that big a deal. It would actually be very easy to do for the most part. But I just laugh at this idea that so much has come down on banks over the last 25 years, as far as everything from the Patriot Act with Bank Secrecy Act legislation, anti-money laundering, you got to watch, OFAC with funding terrorism, all this kind of stuff. So all these things have come down, and banks have been nothing but, govern me harder, daddy. But yet the president's like, I think we really should start checking on immigration status of the customers, right? And all of a sudden it's like, it's like panic in the streets and throw everything. It's just too much. It's too much. So I look at, I try to balance that, and I just kind of laugh what in the world? Yeah, not really not that big a deal, guys. And I don't think, and I have often said, it's kind of interesting too. I just would like to point this out. For all of the people that freak out about, mass deportations and shipping illegal immigrants out of the country and all that kind of stuff, you don't need to do any of that. You don't need to do any of that. You don't need to get if you cut off the money. The key is cutting off the money. If you cut off the welfare, you cut off all the free goodies. You basically say, yeah, you can't get a mortgage, you can't get a bank account, you're not going to be able to transfer money. Oh, Western Union, you're not sending all these international payments. If you cut off the money, these people would all self-deport tomorrow. Okay, no ICE agents required, no nothing required. You cut the money off, they go. It's just that simple. Because if you can't, if you're making money but you can't do anything with it. You can't put it in the bank. You can't pay bills with it. You can't do a lot of things. Basically, you could still operate as a cash, but that becomes more difficult. And the thing is, if you create that, the level of difficulty to operate in a specific environment becomes of X degree, the people will self-select out. They will basically say, all right, it's just too hard for me to live and operate here. I'm going back whence I came. So I just like to point that out. So again, if you want this to be more peaceful, and you want to accomplish the mission and still get people to go, cut off the money. It's real simple. Okay, FinCEN proposes further sanctions on Hoyoni Group. If I'm probably not saying this right. The Financial Crimes Enforcement Network proposed amending its final rule that designated the Hoyoni Group as a primary money laundering concern to include any successors, saying the action guards against the group's attempts to avoid being cut off from the U.S. financial system. So this was a Cambodia-based company, Hoyoni, which Huione. So I get, okay, keep an eye on that one. FHA streamlines mortgage policies. So the Federal Housing Administration announced updates to its single-family mortgage insurance program, including an ICBA-advocated change to quality control requirements in accordance with President Donald Trump's executive order promoting access to mortgage credit. ICBA supports amendment governing merger of credit unions into banks. ICBA said it supports proposed changes to the rules governing the merger of insured credit unions into banks. I think that's a good thing. We'll keep an eye on that. ICBA pushes for harmonization of cyber incident reporting rules. ICBA told federal regulators that community banks support strong cybersecurity, but pushed for a process where information can be shared across the appropriate federal agencies. And then finally, ICBA capital proposals should be tailored to support community banks. ICBA told the federal banking regulators that it supports efforts to improve the risk sensitivity and transparency of the capital framework, but urged the agencies to ensure any final rules are appropriately tailored to community banks without increasing the systemic risks proposed by the largest institutions. So there you go. So there is your bank news for the week. Now, I just want to spend a couple minutes here and I just want to talk about the episodes that I put out for this week. So I did one bonus episode last Sunday called BND Strategy Room Bonus. The Kevin Warsh Error at the Fed Begins. Now, this was just a clip from last week's live stream, but I wanted to I wanted to highlight this conversation around the Fed with Kevin Warsh coming in. I talked about the FOMC basically held interest rates steady last week, but Mr. Warsh wants to bring regime change to the Fed. First meeting focused on four main topics: interest rates, Fed statement, i.e. forward guidance, the dot plot, and committees. So again, if you want that Fed information, go check that episode out. On Monday, I released another bank news episode, which was titled Bank News, M&A Update, New CEOs, Regulators, Liquidation Error, and No Geniuses. So now these bank news episodes, I basically just try to take 10 or 12 all banking related articles and I just try to run through them real quick. Basically, a lot of stuff that I don't get the time to hit on here in the live stream. So, but a lot of people really liking that format. Basically, about 15 minutes. I get you guys, not all, but a lot of the banking news, a lot of the main stuff that came out for the week. And people, again, like I said, people really liking that format. So in this week's episode, basically I covered, Santander and Webster deal receives OCC approval. MidFirst Bank will purchase Texas-based Dallas Capital Bank. Michigan-based Isabella Bank Corp will purchase Grand River Commerce for roughly $54.6 million. Tyson Corner, Virginia-based ODNB Financial Corp will purchase Washington, D.C.-based National Capital Bank Corp for $97.8 million. Robinhood is eliminating 300 employees. Fiserv named its next CEO. Mike Lyons leaves Fiserv to become CEO of Truist Bank officially as of September 1st, 2026. Bank analysts have various opinions on what this new hire means for Truist. OCC revises MDI policy. The GAO recommends that the FDIC start to rotate their examiners. A jury awards a plaintiff, Patrick Byrne, $16.525 million in compensatory damages and another $62.9 million in punitive damages related to his wrongful termination from Ameris Bank. New bank notifies customers it is not being liquidated by the Brazilian Central Bank. Cameron Wadley has done an amazing job at Bank of America. JP Morgan, B of A, and others are now challenging the buy now, pay later space. So that was all of the bank information and news covered in that episode. And I just wanted to read that out just so people could kind of get a better understanding of, just kind of the format of those episodes and the type of information that gets covered in there. So, but like I said, a lot of people really liking that format. So I will continue with that for, a little while and just see how that goes. So, okay. Now, on Tuesday, I did an episode on a new financial product that I think is going to become, and because I'm going to show you an article here in the next, 10, 15 minutes. So this was called, on Tuesday, it was called, What Are Perpetual Futures, also known as PERPs. So perpetual futures, also known as PERPs, are derivative contracts without an expiration date. They allow traders to speculate on the underlying asset prices indefinitely. The critical item to note is that with a PERPS contract, you do not own the underlying asset. Perps contracts are different from synthetic futures contracts. Perps have recently come into the news as the CFTC recently approved Kalshi to start trading crypto perpetual futures. Trading volume on Kalshi exploded in the first week with over 1 billion in activity in the first week. First week, they did 1 billion in activity. One of the biggest bets was on the SpaceX IPO. No surprise there. Not everyone is happy about this, however. The CFTC chair, Michael Selig, went on to CNBC to plead his case and justify the approval. Shortly thereafter, CME CEO Terrence Duffy announced that CME will be suing the CFTC over perps approval. CME argues that perps are swap contracts. Perps originally gained popularity in foreign countries with crypto traders as exchanges such as Hyperliquid and Binance began offering this product back in 2016. So there. So now I want you to keep that in mind because perps are, like I said, we have got another article related to perps, and like I said, this product is really taking off, and it's going to be something that is probably going to cause some issues here in the short run. Okay, then on Wednesday, I did the special episode on Alan Greenspan, former chairman of the Federal Reserve, passes away at 100. I kind of talked about that earlier with some of the Alan Greenspan news that we went over, so I'm not going to go through that whole thing again. But like I said, I tried to give kind of Alan his due, if you will, in that episode. So if you're interested, go check that out. Now on Thursday and Friday, I covered a couple of Federal Reserve research reports that I thought were very interesting. So the first one on Thursday was a review of the Cleveland Federal Reserve Bank paper on bank lending to NBFIs. Now, these are non-bank financial institutions. Now, these are not to be confused with NDFIs, non-depository financial institutions. So these are non-bank financial institutions. So again, you got NDFIs versus NBFIs. So just keep the acronyms correctly, right? So anyway, okay. So the Cleveland Federal Reserve Bank, they recently conducted research on the overall risk exposure of bank lending to non-bank financial institutions, NBFIs. Direct bank lending to non-financial business sector in the U.S. has decreased in recent decades, surprisingly. However, bank lending to NBFIs, which then lends the money directly to the non-financial business sector, has dramatically increased in recent years. So the question then becomes, what then is the true credit risk exposure to bank loans that are made to NBFIs? I think it's a very legitimate question. The researcher used the Federal Reserve's novel issuer to holder data to create an estimate of the share of lending by NBFIs to non-financial businesses that are indirectly financed by the banking sector. So again, some very interesting findings there from the Cleveland Federal Reserve Bank. And then finally, yesterday, I did review of Dallas Fed paper on the impacts of illegal immigration on U.S. labor and housing markets. Now, this one, this was a little bit of a hot potato here, folks. This is, if people get hot and heavy over the immigration argument, this was not going to help your argument. So the Dallas Federal Reserve Bank recently conducted research on the effects of what they called unauthorized, what I call illegal, or more accurately, illegal immigration on U.S. labor and housing market. I love the play on words. I love that. Well, they're unauthorized immigration. Unauthorized. Like, no, it's illegal. It's illegal immigration. But anyway, I digress. Illegal immigration on U.S. labor and housing markets. The findings of the paper suggest that local employment increased without significant declines to local wages. However, on a per capita basis, illegal immigration workers reduced wage compensation of the local workforce, which is exactly what you'd expect. In addition, the influx of illegal immigrants caused a demand shock, which increased the cost of local housing and dramatically increased the cost of housing on a national level. Yes, and what bothered me about this report was that the very key paragraph on how this was about a 65-page research paper, all the way down on page 42. in like the last paragraph on the page, they buried the key paragraph in the report. And that was that, yes, illegal immigration caused the pricing of housing to go up anywhere from 20 to 30%. Let me say that again. Illegal immigration caused housing in this country to go up 20 to 30%. So, if you want to blame anything, if you want to get mad about the cost of housing, you need to blame it on illegal immigration. Okay. That is your culprit for the massive increase in the cost of housing. Now, again, don't blame me. I didn't say it. I did not say that. Okay. That was in the Dallas Federal Reserve. It was in their research paper. Okay. I'm just the messenger. Do not shoot the messenger. I am just the messenger. If you want to if you got issue with that, go call the Dallas Federal Reserve Bank and you want to beat up those researchers and the research they did in this paper, go have it out with them. Like I said, I'm just the messenger here on this. I'm just reporting what they said in their paper. Okay, so illegal immigration basically caused the increase in housing of 20 to 30% increase in housing from, wait for it, illegal immigration into the country. So again, I thought it was a very interesting research paper. I thought it was pretty well done in certain respects. So again, if you have any interest in either the Cleveland Federal Reserve Bank's lending to NBFIs or the effects of illegal immigration on U.S. labor and housing markets, check out those research papers from the Cleveland Fed and the Dallas Fed. So, okay, so those were the episodes that I put out this week. And so now let's shift gears, shall we, and get back to our articles. So let's see here. Where do we leave off? Okay. So let's get into, I've got a bunch of things to cover here in the last, half hour, 40 minutes or so tonight. We're going to talk about pay, CEO pay. We are going to talk about the private credit market. We're going to talk about what's going on with AI. Talk a little bit about data centers. We're going to talk a little bit about some of the things that happened with China this week. China. I love it when he says China. All right. Excuse me. So, top paid CEOs smash the 200 million payday. The moonshot deals push pay for company bosses to new highs in Wall Street Journal's annual ranking, 1.3 billion for 4 executives at one senior housing company. I mean, man, you got to be kidding me. And I'm thinking about Mel Brooks in his History of the World. I'm thinking it's good to be the king. It's good to be the king. Man, $200 million payday. I mean, that's just in 1 year. This is 1 year now. This is 1 year. The 100 million plus CEO is back with a bang just a year after 9-figure pay packages seem to be fading. More U.S. CEOs last year crossed the once rare pay threshold than in any year since 2021, and nearly a dozen topped 200 million. Their compensation looked like crumbs, of course, compared with Elon Musk's 158 billion pay package from Tesla, which set a new record and is about 16 times the combined value for all 391 other chiefs in the Wall Street Journal's annual CEO pay ranking. Musk's deal could ultimately be worth $1 trillion. Still, number 2, Shank Mitra, reached 821 million from Welltower, a real estate investment trust focused on senior housing and healthcare. That lands him one of the biggest executive pay packages for a public company CEO over the past decade. Data from My Log IQ shows. Now, it's interesting. I can remember. I'm trying to think. The gentleman who was the head of the NISI, Charlie Gasparino, who was a CNBC analyst, he wrote a book about it. It was called King, I think King of the Club. And oh gosh, I cannot remember that guy's name. But anyway, he got, and this was going back to, I want to say like 05, 06. He got $100 million plus pay package, and people lost their minds, like went absolutely ballistic, and basically saying like, oh, the greed or whatever. I mean, it's amazing here to me that just, about 20 years later, we've got, 16 CEOs. How many CEOs here that, are getting over $200 million? It's just wild. Some of them, getting a hundred, 841 million. Um, and again, I guess, my issue with this is that, I don't disparage anybody from making money, right? I don't disparage anybody hey, get what you could get out there. I mean, that is, our economy. Go out, make as much money as you can, live the life you want to live, all that kind of stuff. So I don't disparage anybody from reaching for the star and the moons, right? The problem is right now with the income, the equity, this disparity in incomes and equity and net worths of wealthy individuals compared with the bottom 50%. We've reached a point now where, okay, you could go make this money. Um, how long you might have that money might be a different story. Now, why do I say that? What's this? Oh, wait. California's billionaire tax collects enough signatures to qualify for the ballot. Backers say November voters could see the wealth tax initiative on the ballots. Yes, you will see it on the ballots. You will see it on there. So the billionaire organizers of California's billionaire tax proposals say they turned in more than 1.5 million signatures to state election officials on April 27th, which could be enough to qualify the initiative for the November ballot. Backers of the act, including Service Employees International, Union United Healthcare Workers West, needed 875,000 signatures to qualify before the June 24th deadline. So, and they got it. They got it, and now it's coming on there. And again, it is as long, and again, what is the justification, for these pay packages? I mean, seriously, how much money do you need? I mean, what is the justification for that? I mean, I'm just asking. I mean, last time I checked, all these people were human beings that put on their pants one leg at a time, just like everybody else. Do they, can they sing and dance and do their, can they do they go to a board meeting and do they do a special kind of song and dance while cooking and cleaning and doing all kinds of fantastic stuff all at the same time while making a presentation to the board? Is that the gist here of this? um so yeah, again, it's just like, yeah, I mean, it's just, you look at pay packages here, 9.9 billion combined pay of the other 391 CEOs in the journal's rankings. um it's just, I mean, yeah, it's just, and then, and you look at, this is the median pay in this chart. Median pay for CEOs of S&P 500 companies is now in 2025. That was up to $17.9 million a year. And again, you look at it, I don't have the exact number in front of me, but when you think about what is the pay disparity between the CEO and the lowest paid employee, I mean, it's like, 3,600 times or something like that in pay package versus the lowest paid employee. I mean, at that point, you've entered a place of just utter ridiculousness, and you really have. And it's crazy. um and again, what I worry about is that, these people being effectively pigs at the trough, basically create the backlash that is coming. There is a backlash coming against billionaires, and it's not going to be pretty. um and this is something that, they're going to have to reckon with. This is why a couple weeks ago I covered, when Jeff Bezos was up on CNBC and he did this long range interview, and he talked about, oh yeah, let's just not tax the bottom, third of society or whatever. Like, and I said, he was just out there trying to play. He was out there trying to placate people. He's not stupid. He knows how much money he's worth. He knows how much money he's made for himself. He knows that sooner or later people are going to say, okay, we don't mind you having a lot of money, but is it necessary to have 100 and $80 billion. Is that necessary? And again, and I'm not arguing whether it is or it isn't. I'm just saying this is the conversation that's coming. This is what's coming, and I thought it was kind of ridiculous. What Bezos said up there in that CNBC interview a couple weeks ago. Basically just like, oh yeah, let's just not tax these people. Again, at a point where most of those people aren't paying any taxes anyway. I mean, that's just the truth of it. But anyway, all right, let's continue going on here. So ranks of the ultra wealthy jump in 2025. So the number of those worth more than 30 million, that's like basically a net worth, like a net worth of $30 million, jumped by 14.4% last year. So the number of ultra wealthy individuals. So you can see here from 2015, we were around 279,000 of these individuals. We are now up to 556,000 individuals. So this number has effectively doubled in the last 10 years here. And, so it's, the number of ultra wealthy defined as those worth over $30 million jumped to 14.4% to 556,000 people worldwide in 2025, driven by the AI trade. The ranks of the ultra wealthy hit a high in 2025 as the AI trade lifted global markets, according to a new report by wealth intelligence firm Altrata. The number of ultra wealthy individuals, those Altrata defines as having a net worth of more than 30 million, jumped by 14.4% last year to 556,000 people worldwide by the end of 2025. That is the fastest pace of growth since 2017. And then you get this. The new arms race in wealth management, winning the ultra wealthy. So more wealth management firms are seeking growth by chasing the surging ranks of the ultra wealthy and their more profitable accounts. CNBC's inaugural Elite Advisors list for 2026 recognized 25 of the nation's leading investment advisors serving ultra high net worth individuals and family offices, selected for their expertise in advising clients with investable assets of 25 million or more. No demographic is growing more quickly than the ultra high net worth households in the United States. So it's very attractive for these firms. Yes. So again, we're seeing the ultra wealthy. The other way of looking at it is, a lot of the investment firms call these people ultra high net worth individuals. Ultra what you ultra high net worth individual. I'm uh ultra high. UHW. Um, UHWNI. Sorry, it took me a second there. UHWNI, ultra high net worth individuals. Basically, usually it's somebody who's worth 25 million or more in investable assets, or has 25 million or more in investable assets. Which again, and that could be this is wealth outside of your house. This is money outside. Like, this does not include your house. This is just money. People, they have 25 million or more of investable assets sitting there, that basically they can put that money into a number of things. They can invest in IPOs, pre-IPOs. They could do private placement memorandums. They can place in all different kinds of funds. They could put their money into hedge funds and private equity funds and all types of what are known as alternative assets. So, and this is basically the arms race now in wealth management, running after these ultra high net worth individuals, and undoubtedly running after these 391 CEOs that all are, just smashing these $200 million pay packages. So again, just pretty wild. And yeah, I mean, we're just gonna have to see where this goes. Unfortunately, with just the way things are trending, I don't think this goes to a good place, because again, and I don't think that people, again, if you can make this kind of money, you could get this kind of money, good for you, awesome, go get it. But I just think that you're getting to a place where people are sitting there and they're saying, you know what, these billionaires are they yield all the tech bros and everything that basically own all these big tech companies. They run around and in a certain respect kind of do what they want and whatever, and they yield a lot of power and influence and everything. And that, yeah, that is sooner or later something's going to happen there where people are going to be like, yeah, kind of a little tired of the billionaire class. Okay, really tired of the billionaire class, and so again, just something to just keep an eye on here. Something to keep an eye on here. So, all right. Let's keep moving here. Let's get into private credit for a few minutes, shall we? So, at this private credit fund, exits have been restricted for 4 years and counting. Wealth advisors fear it could be many more years before investors get all their money out of the fund, which invests in consumer and small business debt. Now, wait a minute. As we get into this conversation here, I thought that private credit was fine. I thought that all these people said, hey, it's all good. It's fine. Nothing to worry about. Nothing to see here. Yet we are seeing all of these funds getting massive redemption requests. We saw it with BlackRock last week. We've seen it with Blue Owl. We've seen it with Cliffwater, with a whole bunch of them. So now this, let's see here. So investors stuck in private credit funds are wondering how long they will have to wait to get all of their money out. One fund offers a cautionary tale, 4 years and counting. The Stone Ridge Alternative Lending Risk Premium Fund, also known as Lendex, has limited the amount of money that investors can withdraw for 16 consecutive quarters, according to people familiar with the fund. One wealth manager estimates it could take 6 years or more to get all of his clients' money out of the fund, which specializes in a niche corner of the private credit world. As more investors have rushed to exit from the fund, getting money out has gotten harder. On September 20th, September of 2022, Lendex investors received 85% of what they asked for in cash, according to an investor update reviewed by the Wall Street Journal. This month, they got 12%, the people said. A similar dynamic has started playing out more recently across the private credit industry because of souring loan performance over the past year and the fear of future defaults, especially among software companies vulnerable to being displaced by artificial intelligence. The exodus of wealthy investors has pressured funds, which typically allow up to 5% of their shares to be redeemed each quarter. That threshold is designed to prevent forced sales of illiquid assets. Right. So then we go to this. Apollo Private Credit Fund hit with nearly 17% redemption requests. So what do we say? Most of these funds normally allow up to 5% every quarter, not every month, every quarter. Last week we had BlackRock, I think, getting hit with 14%. This week now we've got Apollo getting hit with 17%. So investors asked to redeem approximately 16.8% of their shares from Apollo's flagship retail-focused private credit fund in the second quarter, according to a company filing on Monday. The $26 billion fund, Apollo Debt Solutions, limited redemptions at 5%. Redemption requests were about 11% in the first quarter. The result for the second quarter is gross outflows of approximately $700 million compared to inflows of $300 million, according to preliminary numbers disclosed in the filing. The filing said redemptions from offshore investors picked up while U.S. onshore repurchase requests moderated sequentially. Private credit executives have been signaling in recent weeks that elevated redemption requests could persist for some time. You're kidding me. This is shocking. Even more investors want out of private credit. Analysts expect high withdrawals to last more than a year, increasing risk of forced liquidations. So individual investors accelerated their withdrawal requests from once hot private credit funds in the second quarter, adding to the squeeze the industry is facing as fundraising slows and money heads for the exits. So far, investors in 4 large credit funds, including those managed by Blackstone and BlackRock, have requested to redeem about $12 billion in the second quarter, up from $7.7 billion the previous quarter, according to data from the investment bank Robert A. Stanger and Company. The requests add to pressure on the industry, continuing months of turmoil that executives have tried to calm by arguing investors are overreaching to a few losses and a lot of scary headlines. And now here is a chart with your main culprits. So you have the Golub private credit fund, the Golem. I'm call it the Golem, the Golem private credit fund. My precious. He had Cliffwater, Oak Tree Strategic Credit Fund, Blackstone, and of course BlackRock. Um, and again, you could just see how these redemption requests are building here. First quarter, second quarter, there is a lot of panic out there for sure. And then we go to this. One investor's race to get 80 million out of private credit. So many are waiting in line to get their money out of the once popular asset class as redemption requests accelerate. So Chad Heilman had convinced his colleagues at Gibson Capital to pull the plug on one of their most successful recent investments. Their chance to do so was still months away. By the fall of last year, Wexford, PA-based wealth management firm, thought the returns on the private credit fund that housed 80 million of its clients' money had begun to look less attractive. The risks were also growing. The $33 billion fund allowed only one chance per quarter to pull money out. But as Heilman waited for that redemption window, the storm started brewing in private credit. Two high-profile bankruptcies sparked fears in the market. JP Morgan Chase chief executive Jamie Dimon warned there could be more cockroaches lurking. Then private credit manager Blue Owl Capital called off the merger of two of its funds after investor complaints. If a lot of other investors ran for the exits, Hillman figured the fund manager might trigger its right to limit redemptions. As Gibson's director of research, he was left to wonder whether his client's money might get stuck in the fund. We thought we were going to be early, and then we started to get nervous that we weren't early enough, Hillman said. In the following months, the storm around private credit kept intensifying. Investors tried to pull nearly $20 billion from private credit funds that make loans to highly indebted mid-sized companies in the first quarter of the year, forcing the funds to restrict redemptions. The Cliffwater Corporate Lending Fund that Gibson invested in wasn't spared. The redemption requests have accelerated in the second quarter, and investors have to wait in line to get their money out. Some investors are worried that corporate borrowers will struggle to repay loans taken for private credit funds before interest rates rose. Many of those borrowers now also face a growing threat from artificial intelligence, the thinking goes. Other investors are following the herd, nervous about being left holding the bag if funds are forced to sell their best assets to meet redemptions. As the scramble has played out, rumors and fear mongering have ricocheted across Wall Street. Heilman didn't concern himself much with the noise. Gibson's decision to sell didn't start with a panic phone call or a drumbeat of client angst. It began with a realization that underpins the rapidly shifting sentiment about private credit. It simply isn't as great an investment as it once was. Private credit's higher returns relative to other debt investments was an early draw for Gibson Capital. So yes, so that basically that's the story goes. A lot of these investors are getting locked out. They're not going to be able to get their money. Now we have this. This is even worse. Life insurers aren't just investors in private credit, they're major lenders too. So, roughly one quarter of the life insurers tracked by Clearwater Analytics that own stakes in private credit funds also lend to the funds. What? Wait, say that again? The insurance companies that own stakes in the private credit funds are also lending money to the funds. Okay, so wow. Now, I had reported in recent weeks that in private credit, insurers, big time life insurers, had major investments at like up to the tune of almost $1 trillion in private credit. And then and then a lot of insurance companies that deal in basically home and auto, they have been getting into the party. Now, I think they're very late to the party, to be sure, which is, not a good thing again for them. But again, this is troubling. We can see here. Look at this: the median U.S. insurer allocation to private credit. Look at that from 2018. You're talking about 4.17% to now 9.08%. In the course of just the last 7-8 years. I mean, that is crazy. So insurance companies are exposed to the embattled private credit industry in more ways than one, according to a new report by Clearwater Analytics, a portfolio management software provider. About one quarter of the life insurers tracked by Clearwater that hold stakes in private credit funds also lend money to them. The insurers typically lend $2 to the funds for each dollar of shares they own. This doubling down on the funds amplifies potential investment returns, but wait for it, also increases risks for the insurers. Yes. Disclosures that insurers make to the National Association of Insurance Commissioners can include thousands of individual investments in different documents, making it difficult to identify when they own shares in debt of the same private credit fund. The findings offer a window into the complex ties between the insurance industry and the rapidly expanding business of private fund managers. Many fund managers like Apollo, KKR now own life insurance companies, which in turn have become big investors in private credit. So, in other words, the private equity firms buy the insurance companies and then force them to buy into the private credit funds and then wait for it. And then if they couldn't be more pigs, then they make them lend money to the private credit funds. So I mean, it's insane how this incestuous relationship is working here, and it is only a matter of time before something blows up here and we have a major insurer that and subsequently a major private equity firm that are going to be on the brink of going under. And then it will be, oh, you have to step in and save them because wait for it, they're too big to fail, and their problems will like a domino effect ripple through the economy, causing all kinds of collateral damage. Um, yes, you know. So all right, and then we get into all right, okay. So now little bit of Jeffrey Epstein information here. So now Leon Black, who so he refuses to answer questions on NDAs at Jeffrey Epstein hearing, according to Rep. Comer says. So former Apollo Global Management CEO Leon Black refused to answer questions about non-disclosure agreements he is party to during testimony about his dealings with Jeffrey Epstein. Chairman Rep. James Comer of Kentucky said he had issued 2 subpoenas to Black, one for all of the NDAs that he is party to, and a second for a deposition on July 16th. Black, in prepared testimony, said the notorious sex offender Jeffrey Epstein duped him out of more than $60 million in financial advisory fees. Really? Huh. I wonder what he was paying. I wonder what that 60 million bought him. I wonder what it bought him. This is very interesting. I think this guy is trash. He's trash, and he just like and I love how these guys all get selective amnesia, and that's why that these in my mind these BS hearings. No, like why do we not have grand juries convened here? Why do the grand juries that these guys couldn't get away with this BS? If they had to go testify in front of a grand jury, they would not be able to do this. Okay. And then if they plead the fifth, okay, you could plead the fifth, but then that absolutely that um you have now guaranteed that you are guilty of something and that trial is going to move forward now. So again, I don't understand this. And then they sugarcoat this by they let these guys like Wes Lexner, he was allowed to come in like, oh, Les is gonna testify behind closed doors and everything in secret. I were like what? Like what? Like no. No, yeah, this stuff is just unacceptable. This guy is a dirtbag, and he should be up on charges with so many of these other people. It's unbelievable. Again, House committee issues subpoenas for Leon Black over Epstein ties. I don't want the House committee issuing subpoenas. I want grand juries issuing subpoenas. Okay, I don't want these guys testifying behind closed doors and getting special treatment to come in and be like, "Oh yeah, guys, thanks so much for coming over today." And because it goes like this. Hold on a second. It goes like this. I gotta get real serious for a minute. Mr. Black, did you have any kind of relations with Jeffrey Epstein? I absolutely did not have any relations of any kind with that man. I see. Well, that's good enough for me, guys. What time's lunch? Hey, you think we could get tea time by 2 o'clock? Oh, thanks for coming by, Mr. Black. We'll see you next time. I mean, it's a joke. I mean, that's how this stuff goes, and it's insanely ridiculous. Anyway, all right. So that's that nonsense. Okay. Now, let's get back to our perps futures, shall we, for a second? So I did this episode on Tuesday, as I talked about a little earlier. Nonstop trading, loads of leverage, how perp futures are shaking up Wall Street. So CFTC's approval of so-called perps has triggered a sell-off in U.S. exchanges shares and at least one high-profile lawsuit. Now, again, there is a method to my madness here. Okay. I cover these topics for a very good reason because I see stuff like this is coming. And that's why I try this all ties together. All the episodes I do with the strategy room here, the live stream, all this stuff ties together. It all ties together. And that's why I've set up the channel the way I have, and I do all these episodes the way I do. You guys, again, if you watch a lot of my content and you felt like, you'll see how all this stuff ties together. I do those episodes so that you know what a perps futures contract is, so you could sit there and be like, I know exactly what he's talking about. When we get into when this stuff pops up, you know what this stuff is. So anyway, all right, I digress. So the CFTC's approval of so-called perps has triggered a sell-off in U.S. exchanges shares and at least one high-profile lawsuit. So that newfangled contraption kind of derivative that trades at all hours and with leverage grow into a sensation in overseas markets. And now that these perpetual futures are landing on U.S. shores, shares of the incumbent exchanges are taking a hit. So late last month, the Commodity Futures Trading Commission approved the listing of perpetual futures contracts tied to cryptocurrencies at prediction markets platform Kalshi, and allowed Coinbase Global's U.S. customers to access its global perpetuals. The agency also unveiled a regulatory framework that offered registered U.S. platforms a path to launching their own perps. Perps, which never expire and let traders pile on leverage that amplifies their potential gains and losses, have already made their marks in the U.S. within weeks of being listed. Kalshi's basket of perps tied to cryptocurrencies has surpassed 8.5 billion in trading volume in just like 2 weeks. Their rising popularity is already weighing on the shares of some of the large exchange operators that have built their businesses around listings for traditional derivatives, from interest rate swaps to futures tied to crude oil and stock indexes. So, yes, very interesting. So, we are going to keep an eye on this and see how things continue to go with these perp futures contracts. So, again, a very interesting new product on the horizon. I think there's a lot of risk if you're out there trading with this stuff. Be very careful, because what was the key thing I said earlier tonight about these type of contracts? That is that you do not own the underlying security. You do not own the underlying asset, underlying security that these things are traded on. That is a big deal. Very, very big deal. So, all right. Anyway, all right. I am going to continue the prediction market conversation here for a minute, and then we're going to go into the IP stuff. But I'm going to try. I've got about 10 articles left here, and I'm going to try to blow through these very quickly. So Charles Schwab breaks into prediction market business. The brokerage is working with the CBOE to offer yes or no contracts tied to the performance of the S&P 500 index. Now, Schwab has finally woken up. Robinhood and Coinbase, whether they realize it or not, those are their two primary competitors now. And Robinhood and Coinbase, they have been going nuts in recent months. They are locked in a battle. They want to become the all everything financial super apps, and they want to offer stock trading and options and futures trading, and they want to offer crypto and prediction markets and all kinds of stuff. Robinhood is going to try it, I'm sure, to become a bank or get a bank charter here. Also, Robinhood just, they released their own premier business rewards credit card. So again, both those guys are just, they want to be the end all be all of the financial. Basically, they want to offer you the financial world in your pocket, so to speak. And I think Charles Schwab has been late to the game, but they're slowly getting their butts in gear and getting going. They announced a few weeks ago that they're going to get into crypto, that they are going to start offering the ability of customers to buy and sell and get into different crypto products. And now they're getting into prediction markets. So again, they're trying to, I guess, keep pace here, if you will, with Coinbase and Robinhood. But I think they need to be a little bit more aggressive. I think they need to move a little faster. So we'll see. All right. Polymarket, their annualized revenue surpassed 1 billion 6 weeks after its US exchange launch. So prediction market platform Polymarket told CNBC exclusive that its annualized revenues are now north of $1 billion. It comes 6 weeks after the company lifted the waitlist for access to its US exchange, and as its international platform sees huge volume growth thanks to the FIFA World Cup. So yes, so Polymarket's just exploding. We investigated Polymarket's deceptive marketing campaign, and here's what we found. This is a Wall Street Journal exclusive. The promotion bolsters perception that Polymarket lets users make fast and easy money. Polymarket has been banned from letting U.S. users trade on its website since 2022, but the company is waging a secret campaign for Americans' attention on social media, paying creators to film trades on fake websites and hiring overseas workers to make the videos go viral in the US, a Wall Street Journal investigation found. So again, here's some of the ads and stuff right here, showing these guys, we're all making a ton of money. It's all good. I won 6,000, I won 10,000. So the campaign bolsters the perception that Polymarket lets users make fast and easy money as the company attempts to bring its offshore website back to the U.S. In response to our reporting, Polymarket said in a statement that it was committed to maintaining accurate, fair, and transparent markets. We are part of a rapidly growing industry that are constantly evaluating ways to improve, and we're engaging and earning the trust of our audience. Okay. Here are three big takeaways from the investigation: fake bets and fake wins. Number one. Number two, an army of social media users. And then number three, insider influencers. So basically the secret ingredient: pay influencers, pay for a ton of online social media advertising and users, and then basically just make stuff up, make fake bets with fake wins, and just put out this BS campaign. So, and then we get to this. CFTC sues Kentucky over prediction markets enforcement actions, first red state to face such a lawsuit. So again, now I think this is really stupid. I don't understand why the CFTC is fighting with some of these states over this. I really think it's nonsense. I don't know why they're having this, these like cat fights, if you will. I don't get it. I think, again, I get that the CFTC wants to, they want to, foster the growth of prediction markets and all that, but some of this stuff is not good. And we see here what some of the underhanded, dirty things that Polymarkets is doing. And it's not great. And now you have, lawmakers call for federal probe of Polymarket over deceptive advertising. Two senators, one Republican and one Democrat, asked regulators to probe Polymarket's promotion of fake bets following the journal's reporting. So that was the end result. We got that article with the investigation, and now we got a bunch of lawmakers saying, yeah, we need to have an investigation here. We need to see what is really going on. So we will keep an eye on a lot of that and see, what happens. Now, all right, now let's switch gears to AI for a few minutes. So the new push to ready millions for AI career upheaval. Coalition of employers, state governments developing a strategy to help workers respond to the AI age. So just how many jobs will AI upend? A new coalition of companies and policymakers said it is time to ready the U.S. workforce for major disruption, no matter the ultimate scale. To that end, the bipartisan consortium, which includes state governments, philanthropic groups, and employers ranging from Amazon and Microsoft to Bank of America and Eli Lilly, is coming together to develop a new people strategy for the artificial intelligence era called Raise Up. It launches Thursday and will be led by former Commerce Secretary Gina Raimondo, who served under former President Joe Biden, and former Indiana Governor Eric Holcomb, a Republican. Its mandate, they said, isn't just to rebuild retraining programs, but also to reconsider decades old policies such as unemployment insurance and act as a working lab for testing the most effective ways to transition workers to new fields. The group will explore corporate incentives for employers to hold on to workers whose jobs are disrupted by AI and prep them for new roles. So, how much? Who wants to bet that this committee, if you will, how much you want to bet that their big answer to all this is going to be, wait for it, universal basic income? I can almost guarantee you that is going to be their answer. Their answer is going to be, well, it's just going to cost so much to retain these people. It'll just take too long. It's pointless. Let's just put them on the government dole forever and create the ultimate permanent welfare government state, and they could just become useless eaters. I mean, people on universal basic income, and that's what we'll do. I could see it now. I hate to be so cynical, but I can see it now. So, and anyway, so then we've got the Trump administration. The going back and forth here is kind of wild. So we've got the Trump administration rolls back part of their Anthropic model ban. The government is allowing trusted partners to access the Mythos 5 model following a 2-week restriction that rattled the tech industry. So now we got them rolling it back, and we had Trump saying, "Oh yeah, Anthropic's okay now. It's no big deal." Is it? Is it? Let's see here. Then we get OpenAI limits access to new models, citing government security concerns. Really? Company says White House reviews of AI releases shouldn't, however, become a long term default. Ban on Anthropic's Mythos model remains. But yeah, until they rolled it back. So OpenAI said it is limiting access to its newest artificial intelligence models after discussions with the Trump administration, but warned that the recent trend of the White House restricting industry activity on national security grounds on a case by case basis shouldn't become the norm. Yeah, it absolutely should become the norm. And again, I've said this before, I don't care about this dude's bottom line. I care about companies and major industries being wrecked by AI. That is what my concern is. I don't care about this clown and his IPO and his bottom line and him, trying to snake billions of dollars out of a nonprofit organization. I don't care about that. I don't care about, where's my Anthropic buddy here? Where's he at? Sorry, I skipped ahead here. Yeah, here's Mr. Anthropic here. I don't care about this dude's bottom line. I could care less. They don't get their IPOs and their billions of dollars. I don't care. And why do I say that? Oh, look at this. AI powered cyber attacks on advanced systems may be months away. Intel agencies warn. No, bleep, bleep, bleep. The statement did not reference any particular AI firms, but recent industry discussion has focused on Anthropic's Mythos 5 and Fable 5 frontier models. Oh, you're kidding me. Advanced artificial intelligence models may be able to breach and overwhelm the cybersecurity defenses of governments and businesses worldwide in a matter of months, a partnership of intelligence agencies warned on June 22nd. The Five Eyes Intelligence Oversight and Review Council, an alliance of intelligence and security agencies from the United States, the United Kingdom, Canada, Australia, and New Zealand, issued a joint statement that raises alarms over the threats of frontier AI models. Frontier AI models are anticipated to exceed current industry expectations, fundamentally transforming both offensive and defensive cyber capabilities. The timeline is not years, it is months, the statement said. Really? Wow. Um, they warned world leaders and businesses to assess the risks of frontier AI to respond quickly and prevent malicious actors from exploiting software breaches that could impact national defense. Boards and executives should ensure cyber resilience is in place and works under pressure. It is not enough to have controls. Leaders must be confident those controls will perform during a real incident. This requires reassessing long-standing trade-offs and using AI deliberately to strengthen defense, not just improve efficiency. Monday's statement from the Five Eyes did not reference any particular AI firms, but recent industry discussions has focused on Anthropic's Mythos 5 and Fable 5 frontier models. So again, yeah, I mean, this is just I mean, this has gotten, in my opinion, this has gotten utterly ridiculous. And the fact that these clowns are sitting, that the fact that these clowns have been able to run like a bunch of cowboys through the streets doing whatever they wanted, okay, has now brought us to this point. And it is ridiculous. It is absurd. And they need to be reined in. I'm tired of saying it. They need to be reined in. And then look at this. So OpenAI and Anthropic face new AI reality as users shift from token maxing to token efficiency. That means their users have run out of money. They discovered, see, OpenAI and Anthropic, they discovered this little thing that when you go to get an IPO, you have to show that if you're not profitable, that you're good, that you have to show the future investors that if you're not profitable, that you're going to be able to be profitable. You're going to reach, you have to show a path to profitability. That's why all of a sudden they jacked up their rates. They started charging money for everything under the wazoo. And now all of a sudden, all these companies that were AI gung ho to the max, guess what? They're running out of money, baby. They're running out of money. And that's going to put a big crimp on the crimp on the AI spending means no IPOs. Okay, it's that simple. Um, as companies move to rein in AI spending, OpenAI and Anthropic may have to reckon with slowing growth. Yep. Open source models are emerging as cheaper alternatives as tech giants Microsoft, Amazon, and Google are all proposing offerings focused more on efficiency. Some of the largest enterprise customers may start limiting their out of control token spend. Yes. Obviously, yes. Then we get to this now. OpenAI is reportedly delaying its IPO. What is this ad? Here's when Kalshi traders think it will be announced. Yeah, they think now March 1st, 2027. Yeah, that may not happen. Then we get down to, so maybe this is part of the reason. See how Sam Altman's personal investments benefit from ties to OpenAI. OpenAI's CEO holdings in Helion and other companies have seen significant upswing since the AI giant explored or sealed tie-ups with Altman-linked startups. Yes, this guy's got like a whole ecosystem going here. He's got business software, biotech health, chips and energy, fintech, air and space, and other. Yeah, he's got, and here we go. Look at this. Investor, OpenAI, Helion, Y Combinator. Investor, Y Combinator is a big VC company for people who don't know. Then we get SoftBank, and then we get Thrive Capital, and we get the method, then we get methodology here. So yeah, so you can see, but you can see all these crazy inner workings here of all this stuff, right? OpenAI, right? And then we get down to here. Tech companies would have to pay AI data center costs under bill moving in Congress. Now, wait, I kind of skipped up something there for a second. So Sam Altman, one of the reasons why he is backing off this OpenAI is because there's a lot of senators that are basically starting to ask a lot of questions about all the stuff that Mr. Altman's got going on here, all these different tie-ups and all these different, is this massive web that he has created. This is going to become a major issue for his wanting to get his IPO. I'm not going to say it's going to totally stop his IPO, but it's going to become a major impediment for sure. So we will keep an eye more on that. Let's to the data center stuff for a second. So tech companies would have to pay AI data center energy costs under bill moving in Congress. So the House of Representatives on Wednesday will begin considerations of a bill to force tech companies to pay for artificial intelligence strain on the power grid as voters across the country express dissatisfaction with data centers driving up utility costs. You better believe it. The Ratepayer Protection Act, a bill that would require state utilities to consider creating a large load standard that would require data center builders to pay for upgrades to the grid needed to power them. Yes, I 100%. 100%. Companies are demanding states cut red tape. Data center weary voters may think differently. So Pennsylvania Governor Josh Shapiro announced the largest economic development deal in state history 1 year ago. The 20 billion deal involves two massive Amazon data centers for cloud computing and artificial intelligence, and public opposition has increased. Yes. Shapiro, a Democrat, has rolled out a new set of strict guardrails for data centers, but they complicate one of the governor's most cherished economic priorities, cutting red tape. Yes, quite the web we weave, right? So, and then we get to how AI data centers lost the PR war and what it means for businesses. So let's see here. More than 70 state and local governments have restricted or banned AI data centers altogether. Business leaders failed to build public trust before announcing major data center projects. 25 data center projects were canceled in 2025, about four times as many in 2024. So the multi-trillion-dollar push for data centers has sparked something increasingly rare in American politics, a transpartisan backlash. And there are lessons in public relations that business owners can learn from it, experts say. So again, and I'm not going to go into the whole thing, but all you need to know is that yes, these companies, and we know who they are: Apple, Google, Amazon, yeah, all Meta, like they all, you know, all these firms building data centers like crazy. They have lost the PR war because people are basically they've gotten a glimpse of what these mammoth data centers do, and they're not happy about it, and they do not want them in their backyard, and I do not blame them. All right, and then U.S. bets billions of dollars in low-cost loans can revive nuclear power. So, Energy Department will let utilities tap government funds to kickstart reactor orders. Yes, so this is so again, the Trump administration is so eager to see a nuclear power renaissance that it is starting to fund billions of dollars for reactor orders. So yes, I think we have something. The loans are intended to speed up construction of 10 reactors in the U.S. Five loans will be available for projects with two reactors each. So yes, so we're getting seeing that. Then we go to at nuclear Woodstock. Developers celebrate rapid advancements in reactor design with third novel reactor set to achieve criticality and meet President Donald Trump's July 4th challenge. The future is now for U.S. nuclear industry. So, with a third advanced nuclear reactor prototype in less than a month set to reach criticality next week, United States Energy Secretary Chris Wright projects that as many as five more first of its kind reactors, including several that could fit in a pickup truck bed, will be federally cleared for commercial development in 2026. This is one thing I've always said about nuclear energy is that one of the biggest problems is that the technology around nuclear energy has advanced dramatically in the last 25 years. It's just that there's been so much political pushback against nuclear energy from the Democratic side of the aisle that a lot of that stuff was not allowed to be brought to the forefront. Now, I also blame Republicans for not making it a priority to bring it to the forefront. That's also part of the problem. They did not make the case for why we should continue to. They just said, "Oh, we should. It's nuclear energy is cheap, and we should continue investing in it." No, talk about how they can make it smaller and cheaper and safer, and we don't have to. We won't have to worry about these massive 3 Mile Island meltdowns in the future. They need to. You got to sell it, man. You got to sell the steak with the sizzle, man. Let's go. But again, I think this is good news. We are beginning to see massive increases in technology around nuclear development, and I am very excited to see what they bring up in the future. So now, all right, so three articles here on China to end, or just a couple of articles on China to end here. So China slaps restrictions on dozens of U.S. companies. The move comes after the U.S. expands its military-linked company list to include Alibaba and Baidu. So we get this restriction here. Then we get China sharpens tools for hitting back at foreign sanctions. So Beijing is preparing a new law that would add to its ability to punish foreign companies and individuals deemed to harm Chinese interests. And then we get this finally: how China undercuts the U.S. in Iran. Beijing has built up the use of the yuan for the oil market and other international trade, giving Iran and Russia a way to evade Western sanctions. Now, again, a lot of this comes back to the Chinese wanting to make the yuan the reserve currency for the world, working with the BRICS nations to make that a reality, and now basically undercutting and finding ways for Russia and Iran to evade sanctions from the US, i.e., the SWIFT system and other things that can be used to try to basically make their lives hard, as it were. So, but we'll keep an eye on all these things and see what happens with all that. So, all right. Wow. Oof. Man, that's a lot, right? That is a lot. So, all right, I'm going to go into wrap up mode here, guys. Let me fire up my story of the week here, my quote of the week. Let me go over my items here. So where my banners? I got to get my banners out. All right. So if you are listening to the podcast on Apple Podcasts or Spotify, please leave me some good reviews. Could really use some good reviews on Apple or Spotify. Please make sure to do that. Please make sure to visit the website at www.thebankernextdoor. I'm working on, there's going to be a lot of new updates coming to the website the second half of the year. So stay tuned for that. I'll be, over the next 6 months, I'll be announcing a bunch of things that I literally have just started working on the last few months. So I think a lot of really cool, good things to come with that. Make sure to subscribe on YouTube to get the latest and greatest via post. Like if you want to know what I'm going to cover, like I posted last night, what I was going to cover tonight in the Strategy Room live stream. So if you're ever curious, like, oh, I wonder what he's going to cover tonight in the live stream, I put that post out there. If you're curious about what are the episodes that he's going to put out this week, I put a post out there saying, oh, here's all the episodes I'm putting out. So again, if you want the latest and greatest, make sure to subscribe on YouTube. You get all those posts, see what's going on here on the channel, and that's a good thing. You can send comments to me at info@thebankernextdoor. That's how you get a hold of me. So if you have questions, if you have topic recommendations, anything like that, you can reach me at info@thebankernextdoor.com. You can follow me on social media. I am up on Getter X and Truth Social with probably more platforms to probably come before the end of this year. I've had people on me forever about getting on Instagram and TikTok, and I've kind of I have avoided doing some of that. But hopefully, like I said, we'll see what happens with some of these other platforms. But I will tell you, I do spend the majority of my time on X. So if you want to come follow me there, that is fine. And just remember, BND is on YouTube, Rumble, and all major podcast platforms. New episodes come out every Monday through Friday at noon, and the BND Strategy Room is every Saturday night at 8 p.m. Here on YouTube with definitely Rumble soon to follow. I should have that up in the not too distant future. So, okay. That being said, all right, let's go to our story of the week here. So our story of the week comes June 23rd, 1836, with the U.S. national debt eliminated. Could you imagine that? Eliminated the previous year and the federal budget running a huge, huge surplus. President Andrew Jackson's plan to distribute the surplus to the states was enacted. Jackson repeatedly declared that with no more national debt, the U.S. would always have a budget surplus. Now, a big thing happened in 1836. Andrew Jackson canceled the charter of the Second Bank of the United States, which was the second central bank of the U.S. So Andrew Jackson did two major things during his presidency. He paid off the national debt, and he got rid of the central bank. Imagine that, right? And then the U.S. saw literally 80 years of the greatest amount of prosperity that any country has seen thereafter. Now, to be sure, we went through some panics, we went through some economic turmoil, some other things like that. But the growth and prosperity that we saw from getting rid of the central bank and from paying off our national debt was absolutely immense, absolutely immense. So I cannot underplay that. And then that's why Andrew Jackson is one of my favorite presidents. If you've never studied Andrew Jackson, his history, his life, the hero of the Battle of New Orleans. Yes, Andrew Jackson he was the man, dude. He was the man. And in his day, he had Jacksonians. Okay, that was his big army. He has Jacksonians, and he is widely considered one of the most populous and most beloved presidents that we have ever had. You read about the procession that he had when he died is absolutely incredible, absolutely incredible. All right, now our quote of the week. All right, this comes to us from Charles Dickens, and it goes like this. Reflect upon your present blessings, of which every man has many, not on your past misfortunes, of which all men have some. So yes, a good quote there from Charles Dickens. So just a final note. I will not. There will be no. Unfortunately, I know this is very sad. There will be no live stream for the next 2 weeks. I'm taking a couple weeks off. I've got some other things going on, but I do have all new episodes coming out this week coming up. And then for a couple weeks thereafter, I actually have a couple of weeks of best of. I'm going to do a whole week around the Lords of Easy Money series, because the series was a series I did a while ago, but I want to try to bring that back to the forefront a little bit. So I'm going to kind of put out a compilation of best of the Lords of Easy Money series for a week, and then I'm going to do a best of interviews week. So I'll put out my top 5 interviews on the podcast again. So I think some really good stuff there that if people have missed it or never got a chance to see it, I will have that out there for people to watch for the next couple weeks. So that's the plan for the next few weeks. So I will, like I said, I will be back on July probably 20th, something like that, for the live stream. So until then, I want you to stay safe out there. Have a great 4th of July, and just be safe. Shoot off some good fireworks and have a good time out there. And I will see everyone again real soon. Real soon. Thank you for being here in the strategy room with me. I really appreciate all the listeners and the followers out there. Love you guys. And again, I will see everybody soon. Thanks a lot.